Welcome to this video of asset disposal. We are going to consider the steps and calculations that are required to record the disposal of an asset. Formulas. Depreciation, we have two methods, the straight line or fixed method and the diminishing balance method. Having a look at the straight line or fixed method, it is the cost price times percentage times number of months divided by 12. Our diminishing balance method is our carrying value times percentage times the number of months divided by 12. Our total depreciation is our depreciation at the beginning of the year that we are given plus the depreciation that is extra that we are going to be calculating. Our carrying value is our cost price minus depreciation. And the carrying value, remember, is the one that we're going to need for calculating the diminishing balance method. Lastly, our profit or loss is calculated by our selling price minus carrying value. Please note that a negative in the calculator is equal to a loss and a positive is equal to a profit. Steps. Number 1, we're going to identify and dispose the cost price. Number 2, calculate the extra depreciation. Number 3, dispose of the accumulated depreciation together. Number 4, record the selling price. And lastly, number 5, determine whether it is a profit or a loss. Note, always use timelines. Timelines are very important and are very helpful. And write out important information such as the cost price, the selling price, the year end, year start, and the date of disposal. We are going to have a look at 2 examples, and one is going to be according to the straight line or fixed method, and the other one is going to be according to the diminishing balance method. Now, example 1, it reads, the cost price of an asset is 120,000. The depreciation at the year start is 40,000, and the asset was sold on 1 October 20.7 for 45,000 Rand. Depreciation is calculated at 20% per annum on the fixed method. The financial year end is 28 February 20.8. Now this is our timeline. This is our year start, our year end, and this is the 1st of October 20.7, which is our date of disposal. Important information to be written out. This is our cost price, 120,000, the selling price, 45,000, the depreciation at the beginning of the year, 40,000, the year end is 28 Feb 20.8, therefore the year start is 1 March 20.7. Our date of disposal is 1 October 20.7. Now, in this financial year, we have only had the asset for 7 months, from March to September. We do not include the 1st of October or the whole of October because it is not the whole month. Now, the solution for example 1, we are going to calculate our depreciation at the fixed method, which is cost price times percentage times number of months divided by 12. Our cost price was 120,000 times 20% times the 7 months divided by 12. it results in 14,000 of extra depreciation. Our total depreciation then is going to be depreciation at year start or beginning of the year plus depreciation, which is extra that we calculated here. At year start, our depreciation was 40,000 plus 14,000. It is equal to 54,000 Rand. Now we're going to calculate our carrying value, and it's our cost price minus depreciation. Our cost price is 120,000 minus depreciation of 54,000 Rand, is equal to 66,000 Rand. Profit or loss equals selling price minus carrying value. Our selling price was 45,000 Rand minus our carrying value, which is 66,000 Rand, and it results in negative 21,000. Therefore, it is a loss because we have got a negative. Example number 2, which is on the diminishing balance method, it reads, an old printer bought for 120,000 Rand was sold for cash on 31 August 20.5 at carrying value. Accumulated depreciation on the printer was 38,400 Rand on 1 March 20.5. Depreciation is written off at 20% according to the diminishing balance method. Now, this is our timeline, and this is our year start. This is our year end. And this is our date of disposal, probably here. And we see that it is March, April, May, June, July, August, 6 months for the asset on hand in the current financial year. Our cost price is 120,000 Rand. Selling price is the carrying value to be calculated. Depreciation is 38,400. Year end is 28 Feb 20.6. Therefore, year start is 1 March 20.5. Date of disposal is 31 August 20.5. Our solution for example 2, we are first going to calculate our carrying value. So carrying value equals the cost price minus accumulated depreciation. It's 120,000 minus 38,400. It is 81,600. Remember that this is also our selling price because we sold the asset on carrying value. Then we have extra depreciation, which is our carrying value times percentage times number of months divided by 12. It is 81,600 times 20% times 6 divided by 12. And we get 8,160. Our total depreciation is then going to be depreciation at the beginning of the year or year start plus the extra depreciation. It's 38,400 plus that extra depreciation, which is 8,160. It is equal to 46,560. Our carrying value now is then going to be cost price minus accumulated depreciation, which is 120,000 cost price minus this accumulated depreciation, which is 46,560, and we get 73,440. Lastly, our profit or loss equals the selling price minus carrying value. Our selling price, remember, is that carrying value, so it's 81,600 minus 73,440, which is our carrying value. It is equal to 8,160, and it is a positive amount, therefore it is a profit. We have come to the end of this video, and I really hope that it was of great help.